All right, everybody, look at this chart right now, and I want you to guess which asset this has been over the last while. This is a 20-year chart, and we can see the returns of the S&P 500, 629%, and this particular asset is up 660%. It has outperformed the S&P 500 over a 20-year time period just recently, just in the latter half of 2024. That asset is gold. It has gone on a monumental run, and a lot of people viewed gold as an asset that potentially wasn't necessary for their portfolio. They didn't really want to own it because the returns were really not all that good. I mean, we can look from 2012 to 2018 there. We went through a substantial gold bear market while the S&P 500 continued to accelerate. But we now have gold outperforming the S&P 500 over a 20-year time period, and it has definitely been a very solid asset to own in your portfolio over the last while. Now, when we span that chart out to, say, a 5 or a 10-year period, there's no doubt that the S&P 500 has performed better than gold, and that is primarily due to the massive run-up post-financial crisis, whereas gold did fairly well during that, crisis mode when equities weren't doing all that well. But there is still very little doubt that a lot of investors would do well holding a certain portion of their portfolio in an asset like gold. Yet many investors do not do it, and I'm getting a lot of requests to actually cover gold stocks on the channel, which is exactly what I'm going to be doing in this video. I'm going to cover two stocks that are pretty different in their overall business models, but do get you exposure to the sector in very different ways. So you're going to want to watch the whole video because these companies operate differently. They are exposed to the price of gold differently, and overall deciding which one to own, if you do want to own them, is going to be heavily dependent on your risk tolerance. So let's dive right into the video. But before we do, remember to like, subscribe, drop a comment down below, and let me know what sector you want me to go over next. And also, there is a free report in the description below on my 3 top options for 2025. One of the stocks I'm actually going to go over today is inside that report and has performed exceptionally well over the last while due to the rising price of gold. But let's dive right into it. So the first company I'm going to be going over is Franco-Nevada. So Franco-Nevada is a streaming and royalty company. And what exactly does that mean? Well, it means it does not directly own mines itself. What it does is provides financing capital to gold miners, or it even operates in the oil and gas sector. Small portion of the business, but it does operate in that sector. It will provide financing to miners who are looking for capital to get mines started up, things like that. And in exchange, what they will get is either a royalty on production, so say a certain amount of production, or they will enter a streaming agreement, which effectively gives the company the option to purchase gold at a set price. So the royalties are kind of a fixed cost of production, whereas the streaming end of things is, we will give you this capital if you agree to sell us gold for XX amount of dollars, as production starts to ramp up. So the main benefit here is the company is not exposed to operating costs. And when we come to the company's actual data here, we can see that their operating margins are 66%. And this is because they are not exposed to those overall operating costs that many miners are going to go through. So I'm going to give a bit of a spoiler alert on the second company I'm going to talk about, and that is Agnico Eagle Mines. But if we come here, their operating margins are 41% compared to Franco's, 66% plus operating margins. And it can do this because it does not own any exposure to the mines. It doesn't have to rent the equipment. It doesn't have to pay for the fuel. It doesn't have to do any of that stuff. Instead, it just gives that capital to the miners and in turn gets returns in the form of fixed gold prices or royalties. So what this also means is that Franco-Nevada is not as exposed to the price of gold as, say, a mining company, one that actually directly mines the gold and benefits significantly from an increasing gold price. Franco-Nevada does benefit from higher gold prices, especially in the cases of its royalty segments, And I mean, in its streaming segments as well, because it could be getting a large discount on the overall price of gold. But that doesn't necessarily mean it won't benefit to the upside from rising prices. It definitely is. It's likely not going to increase as much as a pure play gold producer in a rising gold environment, but it's also on the flip side, likely not going to see as much volatility if we enter a gold bear market after this run up. So when we look to quarterly average prices for Franco-Nevada, it's crazy the amount of increases they're seeing on their precious metals. Obviously, this company does have some oil agreements, and oil is struggling. We can see West Texas Intermediate, their average realized prices are down 7.2%. This does make sense. Oil has faced a lot of pressure, but when we look to gold, silver, and platinum, we're seeing a 38% increase in the average gold price. We're seeing a 36% increase in the average silver price. So as a result, this company's overall financial results are very strong. If we look at this chart on revenues, we're talking Q1 2024, 257 million. Then we're looking at 368 million this year, and adjusted EBITDA 216 million up to 322. And they're maintaining a 87% adjusted EBITDA margin in the first quarter of 2025. Again, we come down here, we're seeing revenue up 43.5%. We're looking at earnings per share $1.07 versus 71 cents last year. So we're looking at a 50% increase. And when we look to their overall makeup, we're seeing that, the bulk of it will be that streaming segment where the company effectively gets cheaper prices of gold for providing finances. So that is the largest segment. And when we actually look to physical assets, we're looking at gold is the primary driver for this business. Silver, relatively small, and we can see oil and gas. They make up, I believe, around 10% of the business. So one thing you need to know about Franco is it has zero debt on the balance sheet. It is debt-free, and when we come to the available capital, we're looking at closing cash of $1.12 billion, and we're looking at a $1 billion credit facility, which I believe is, it's untapped. This company is debt-free, and it has about $100 million in inventory in terms of gold. So why is this key for a company like Franco? What the company will typically do is take a large amount of smaller bets on miners. Some of them won't work out. Some of them will become very profitable. And in the end, with this liquidity, it can finance it without having to go into debt. It can give capital to these miners who can then utilize that capital, get production running, and then Franco definitely benefits from that agreement. This is why the liquidity is pretty essential for a company like this, and the fact that it's debt-free means that it can effectively not pay interest on any of these bets that it does make. So the final thing I want to talk about with Franco would be valuation. So the company is trading at 31x expected earnings, and it does have a PEG of 1.29. The PEG effectively is it compares the company's current price to its forward expected growth, and what a 1.29 PEG ratio means is the company is slightly expensive here, not absurdly expensive. The thing is, the rising price of gold here has caused a lot of bullish activity among a lot of gold producers and a lot of streaming companies. You're definitely not getting these companies cheap right now, but if we do look to the expected growth for Franco, when we look to annual results, we're looking at $6.13 in earnings in 2025, and that does jump up to $6.93 in 2026, which is a mid double-digit growth rate. So that's definitely nothing to scoff at, but analysts do expect it to slow down in 2027, $7.13. However, it's very, very hard to predict operational results 3 years out, let alone the price of gold 3 years out. So I actually feel that for risk-averse investors, Franco-Nevada is one of the best ways to get exposure to the price of gold. Now, that's not to say that Franco-Nevada is some sort of slouch when it comes to overall returns. I mean, when we look to 10-year overall returns here, we're looking at 270%. Don't get me wrong when I say it's, the risk-averse way, which would lead to lower returns. I mean, they have been one of the best performing companies in the gold sector in Canada, primarily because of that resilient business model. By risk-averse, I just mean that this company is likely to be able to weather a gold bear market better than a producer because of that streaming agreement, because they are not exposed to the operating costs of the mines, and because of its liquidity situation, it will be able to fund new projects without having to take on an excessive amount of debt. Now, the one thing, if you follow this company, you might notice I did not mention is the Cobre Panama situation. I'm not going to speak too much on that in this video because the company has written that asset off. Quick explanation, they had a streaming asset from First Quantum that ended up getting into some troubles and completely shut down. It was about 20% of Franco-Nevada's EBITDA, and it ended up getting closed. The company does not expect it to come back online, so it's kind of completely written it off. But if it does come back online, that would be a huge boost for the company. But overall, great company, one that I would have no problems adding at this point in time, even with sky-high gold prices. It's just an outstanding performer and has been for many decades. So the second one I want to go over is Agnico Eagle. Now, this is a gold producer, and Agnico Eagle has been around for quite some time, but if you remember back in the 4 or 5 years ago, they used to have Kirkland Lake. Well, those two companies merged and made effectively one Agnico Eagle Mines. They merged together, traded as Agnico. And the one reason I do like this producer a lot is it has a lot of exposure to very safe jurisdictions, mining jurisdictions. I mean, if we go back to the Franco-Nevada case, the Cobre Panama situation, that is not a very stable mining jurisdiction, and ultimately the mine ended up getting shut down. Now, with Agnico operating in Canada, the United States, Australia, there is less of a chance that that happens. Certainly, there always is a chance, and obviously when gold operators operate these mines, it is an inherently riskier business than something like Franco. But the fact it is in these jurisdictions makes it a little more reliable and is likely going to be why it trades at a higher premium to many other gold producers. So when we come down to the overall results for Agnico, they're continuing to kill it as well. We're looking at, Q1 2024 realized prices of around $2,000 an ounce. We're looking at $2,900. I expect that to keep increasing as they continue to file earnings. And we're looking at all-in sustaining costs, which is effectively what it costs them to mine a ounce of gold. That's $1,183. That's actually down year over year. And when you're looking at realized prices of $2,891 and all-in sustaining costs of $1,118, this is a very strong gap. Agnico is, especially for the jurisdictions it operates in, it's a relatively low-cost producer, which is ultimately pushing results quite a bit at this point in time. We're looking at free cash flow, $396 million last year to nearly $600 million this year. Huge jump in free cash flow. And when we look to the balance sheet, this is where the company really shines. So we're looking at free cash flow. It's remained relatively steady over the last year or so. But the one thing I want to show you is that cash and net debt position. So net debt would effectively be its debt minus its cash. So back in Q2 of 2024, $922 million in cash and $920 million in net debt. So effectively that means it would have had around $1.84 billion in debt, because obviously you're taking this cash, subtracting it from the overall debt to get your net debt position. And we can see that as gold continued to go through this bull market, that net debt position just continues to decline, and it is effectively at zero now. If we look to the balance sheet, the company has a lot of cash on hand. And actually, first I'll go over the debt situation here. We can see, $2.6 billion in September of 2023. They've reduced that all the way down to $1.6 billion. And when we actually go to the balance sheet, we can see the company has a large cash position. We're looking at $1.3 billion in cash and cash equivalents on debt of around, 1.6. So this is a very strong position for the company to be in for a few reasons. First off, producers, again, are much more exposed to the cyclical nature of gold. If we get a gold drawdown, this company is going to be in a position to survive the drawdown, to continue to maintain production, to continue to grow that dividend, and possibly even with this large cash position and very little debt, buy back shares, which could be pretty key if gold goes into a bear market. When you're looking at gold producers, you want gold producers who have bulletproof balance sheets, and this is definitely one of them. We effectively have the same amount of cash on the balance sheet as debt, which should allow it to survive a lot of economic environments. And the best part is even if we don't hit that bear market in terms of gold, if gold continues to rise or even continues to be maintained at these levels, that balance sheet is only going to get better. And when we look at valuations, Agnico, again, it doesn't really trade at that high premium as Franco-Nevada does. We're looking at 17x expected earnings. And that is because this company has a lot of exposure to a lot of outside elements that are effectively out of its control. I mean, we could be talking weather impacts. We could be talking fuel costs, equipment costs, things like that. Those are things that Franco-Nevada doesn't really have to worry about. So as a result, it tends to trade cheaper. We're looking at 23x expected free cash flow, 17x expected earnings, but we do get that PEG of 1.26, around the same as Franco-Nevada, which does kind of tell you that the market is pricing in a lot of growth for these gold stocks. And when we look to actual estimates, we're expected to see a big ramp up in earnings, $5.19 all the way up to $8.43 this year. And then it's expected to stay relatively flat, probably pricing in the fact that gold might not be moving all that much upwards right now. It's went under a huge run. But the thing here is you don't really need gold to go up much longer to benefit from an investment in Agnico, because as I mentioned, we're looking at likely next quarter $3,000+ realized prices per ounce, and we're looking at all-in sustaining costs in the low $1,100 range. So free cash flow, even in a flat gold environment, should continue to increase. The company in that situation could continue to buy back shares. It can continue to invest in new projects, things like that. And I do believe that this is one of the best gold producers in the country, and it's just gone on a great run over the last while. We're looking at a share price of $61 in early 2024, and now we're all the way up to $148. It's just performed outstanding over the last while, and I do believe it's Canada's best gold producer. Now, this would be more for the people who might be a little more risk on when it comes to their investments. I mean, gold producers, while again, as I mentioned, Franco, more that risk averse play, gold producers highly susceptible to a lot of things that are completely out of their control, and generally their share price does take a bit of a beating. These are not typically companies you would look to buy and hold long term. You kind of do have to time the cycle a bit. You have to buy when prices are low, sell when prices are high, because generally over the long term, they don't really provide all that well of strong long-term returns because of the cyclicality in the price of gold. However, there's still a lot of bullish cases for at least maintain prices of gold and even accelerating prices of gold. And overall, you would have effectively been performing in line with the TSX before this huge run-up in the price of gold. So I wouldn't necessarily say it's a bad long-term hold, but typically with these cyclical plays, you will find yourself having to enter and exit. So again, this is more of the risk on play for somebody who's looking to take advantage of the crazy results that the producers are realizing right now, whereas Franco-Nevada is, in my opinion, kind of the buy and hold, stash it away, worry about it in a couple decades, which is pretty much what I believe is the situation for the three stocks that I have in the report down in the description, and Franco-Nevada is one of them, so you can grab that for free in the description. But that's pretty much it for the video, everybody. Hope you liked it. Again, comment down below and let me know what industries, sectors, individual stocks you want me to go over next. I do give away free premium subscriptions to random commenters, so you're going to want to be a part of that. It's a $300 a year subscription. Great platform, going to make you a better investor. And as always, everybody, we'll see you next time for more great Canadian content.